I want to bring in Kevin Smith. He's the founder and CEO at Crescat Capital. Kevin, always good to have you here. Let's talk a little bit about this big event next week, all right? What are you looking for? I know you're a general bear on equities. What needs to happen to fulfill your thesis?
One of the main points of our bear thesis right now is the fact that that now that the Fed is cutting rates late in the cycle, that it's actually very bearish, not bullish, and the yield curve is already forcing the Fed to be into a severely cutting phase. I think we're looking at three cuts before year end priced into the curve already. And the problem is that monetary policy works with a lag, and so the Fed is really between a rock and a hard place behind the curve. And I'm not sure what we're going to see out of Jay Powell next week, but he's going to have to talk the line and be balanced as usual. And we just see much bigger problems from a macro standpoint here at Crescat.
So this is an uncomfortable pill to swallow for bulls, Kevin, because what you're saying is even if the Fed does cut, it's not going to help your stocks. Am I right? Because right now the big saving grace continues to be, well, once Jay Powell gets in line, we're good to go.
Right. Well, there's a lot of bullish narrative out there right now on the rate cuts, and the problem is monetary policy works with a lag. We've had a 3-year plus tightening cycle, and it's really created this global yield curve inversion and an asset bubble situation where we have 17 countries where the 30-year yield is below the Fed funds rate, because the Fed was the only central bank out there, at the tiller of the world reserve currency, that could actually tighten. They tightened for 3.5 years, and what it created was this asset bubble situation where we have record valuations now for U.S. equities, and people still pouring money into the U.S. because it's the best game in town, but it's getting very late in the game.
Kevin, right now we're looking at the Fed funds and the S&P. I've repeatedly talked about many similarities when you look at the rollover and leading indicators. When you look at the heightened recession type of indicators, they're basically still not where they were at the 2016 bottom during that slowdown. Some of them are where they were in 2011 around the Euro crisis. The big difference between those areas, those periods, and now, of course, is that we don't have this big move in the Fed funds rate under our belt. So, of course, that brings us to the yield curve inversion. But if the yield curve inversion is more sort of a pricing dynamic that is happening in bonds, and let's say this is more analogous to 2016, and the economy doesn't turn deep negative, what does that mean for the thesis? I mean, will stocks just get that kind of Fed model TINA trade still?
The idea that low interest rates just mean higher PE multiples, we think is horribly flawed. And there is no alternative trade has been what has fed this asset bubble market that we have already. When you compare where we are today compared to 2016, we had nowhere near the amount of yield curve inversions that we have today in the U.S. Treasury yield curve. Let alone this global yield curve inversion situation that we have today. And so, yes, that was the Fed's chance. At the end of 2015, they raised rates one time and they paused. The world was starting to blow up, if you remember back then, and yet that year-long pause that we had from continuing to raise rates is what continued to extend the business cycle, and we had nowhere near the yield curve inversions back then. Today, we're much later in the business cycle. Okay,
now the sort of case here then to take the others aside, of course, is we've heard the late cycle a lot. We're 10 years in to this. It's been late for a while. This 2015-16 heard this argument as well. One of the things that I thought was interesting, Kevin, is right now, the searches for recession and the narrative about recession has become so profound that and so consensus. How do we get a recession if everybody's expecting it? Do you worry about sort of the popular kind of narrative building so powerfully that there's not enough sort of, leverage to really get slammed? I mean, if everybody sees this thing coming, how bad could it get?
Well, it's questionable how many people are really buying into the narrative of recession coming. In our view, it's we don't see that as prominently, but certainly with the recent 210 inversion, the yield curve inversion is coming more into the fray in terms of the popular media. I really think that we do have to be concerned that that there still could be more late cycle melt up in the market out there. But the problem with this idea that that there is no alternative to stocks and to the U.S. and is really flawed. I mean, the fact that that there's normally a term premium in the yield curve. What that means is that investors are normally expect to earn a premium on their long-term investments. But when you discount all that future long-term returns from long-duration assets into the present, what you get is asset bubbles. And what needs to happen first, and what normally happens first before the recession comes, is that asset bubbles burst first. And that's what we have to be concerned about with the trade war with China, with people starting to get nervous about the recession. It actually can become a self-fulfilling prophecy. But the other thing is just fundamentals. What we're seeing is an earnings deterioration out there.
Definitely.
In the S&P 500.
Now, I want to go here because, Kevin, I like this point when we talk about it here a lot. It seems problematic that the market climbs on, Fed expectations and valuation growth the last 7 months while the earnings outlook for guidance comes down, all the way down to 165 now, and it's been lowering throughout this earnings season. So that part totally, I get. However, I'll once again kind of take the other side of this is there's still growth, right? There's still 6.5% growth for EPS expected next year. We've spent a good bit of time this quarter talking about semiconductors, and they're actually starting to say that they see the bottom of their cycle. Now, of course, they've all got to talk their book a little bit, these CEOs. But if they're right, like they were right in 2018 and saw the weakness before the bond market came in, what if the bond market has to catch up and these semiconductors have more visibility in the global economy? What does economic strength do to your thesis?
Well, I think the semiconductor example is a perfect one, because if you remember back to the first part of the year, semiconductor companies were all projecting the second half earnings rebound.
Yeah.
Well, where is the second half earnings rebound for semiconductors? NVIDIA just reported a 17% year-over-year decline in sales.
Yep.
So, and then there's this positive spin on NVIDIA, and NVIDIA is up. They're pushing that future rebound story again that already failed to materialize. So I'm just not buying it at all. Okay.
Do you have a way to express it that can still withstand the types of pops that we get on either events like that, or if Jay Powell comes out and he says, look, guys, I'll give you 50 in a single, cut. How do you make sure that from a trading standpoint, you don't get, blown out on that or bleed through as you wait for the big correction?
Well, here at Crescat, we're net short in our hedge funds, and we use a risk model to contain our risk. But we are determined to be net short through this business cycle downturn and this market downturn that we see coming ahead of the recession. And so, yes, we can have pullbacks when it's working against us, but we use a risk model to contain that risk so that we can stay positioned for the downturn that we see coming. And we're not perma bears by any means. Mm-hmm. We're tactical bears. And our models are telling us that now the opportunity is on the short side of the market.
Kevin, do you have a get out level that makes sense to you? Because even when things got real ugly last year, I think the point of the nominal earnings growth that's there is that when we got to 15.5 times PE, the market basically went enough's enough. They started buying Microsoft, they started buying Visa, they started buying companies that do generate earnings growth, and we still have 6.5% next year. Is there a level where you would say, okay, I'm ready to take off some of these shorts? Do you do it on a company specific or a benchmark specific level?
Well, like I said, we use a risk model, and we have a macro model that we use to time the overall exposure that we'll take. So we follow our models, and we don't have specific technical models, but we are forced to trim exposure on the short side when things are not working, and our risk model is blowing out because of that.
All right, Kevin, always really good stuff. We got to leave it there. I know we'll continue the conversation. Love to do so, and we will see you then.